A very good morning to you all. On behalf of Metal Trendzz and BigMint, it is my privilege to welcome you all to today's powerful knowledge session on metal price indexing and risk management 2025 using benchmarks to navigate volatility. BigMint, with its expertise in building reliable and transparent price indexes for ferrous and non-ferrous markets, plays a vital role in enabling the industry to adopt structured, data-driven, and dispute-free trade practices. We are delighted to have their association in this important conversation on pricing mechanisms. I would also like to extend a heartfelt gratitude to our industry supporters and associations for their continued encouragement and support in strengthening knowledge sharing platforms such as this. Another feather in our cap today is participation of London Metal Exchange, the world's premier marketplace for base metals. Their presence adds a truly global dimension, linking our discussions here in India with international market dynamics. This conversation would also be incomplete without the participation of Metal Junction, MCX, and MRAI, whose roles in trading price discovery, hedging, risk management, and industry advocacy have been pivotal in strengthening the Indian metals ecosystem. In today's volatile environment, the need for transparency, robust risk management, and greater cooperation in metals trade has never been more important. Transparent benchmarks are not just numbers, they are instruments of trust, helping buyers and sellers align more effectively, reduce uncertainty, and build sustainable long term relationships. Today's session will explore how indexes are shaping procurement contracts and enhancing negotiations and providing smarter tools to navigate volatility. How collaboration across exchanges, platforms, producers, traders, recyclers, and associations can create a healthier and more resilient metals trade. We are honored to welcome a galaxy of speakers joining Mr. G. Chandrasekhar, co-founder, Metal Trendzz, and a senior journalist and economist to share their insights. Mr. Dhruv Goyal, CEO BigMint, Mr. Joe Yu, Senior Vice President, London Metal Exchange, Mr. Chitranjan Rege, Head PMT, Base Metals and Steel Multi-Commodity Exchange of India, Mr. Tamajit Payne, Deputy Head and Editor, Steel Insights, M Junction Group, and Mr. Sanjay Mehta, Chairman, MTC and President, MRAI. This gathering is a testament to our shared commitment to knowledge sharing and industry advancement. I would like to extend a special thanks to Mr. Dhruv Goyal, CEO of BigMint, for his partnership and valuable insights that makes this forum possible. His expertise in price reporting and market intelligence continues to set benchmarks for our sector. Thank you, Mr. Goyal, and thanks to each one of you for being part of this important conversation. To begin our session, I would request Chandrasekhar ji to share his perspective on key macroeconomics indicators influencing commodity prices in 2025, including inflation, currency trends, interest rates, and much more. Over to you, Chandrasekhar ji. Thank you.
Thank you, Binaji. It's such a delight for me to be in the midst of this, what I call a glittering galaxy of very distinguished dignitaries. Over the next 10 minutes, I'm going to share my thoughts on the macroeconomic indicators and drivers of the global metals market, and also touch upon probably outlook and a few words on index and how important, how critical indexing and use of index is. I am sharing my screen. Let's start by talking about metals price indexing and risk management strategies for 2025. I'm going to, as I said earlier, industrial metals market drivers, how to use index to manage prices is what is the theme of my speech. I've been given 10 minutes and I hope I'll be able to complete my presentation in 10 minutes. Primarily, global macroeconomic developments, all of us know over the last 5 years or so, the world has been buffeted by successive shocks. The first shock came actually in 2020 in the form of pandemic-driven lockdown around the world. And as we were trying to get out of it by 2021, came the second shock, which is the Ukraine-Russia conflict by early 2022, which is actually continuing. And then you also have the Hamas-Israel conflict, which is ongoing. As if all this was not enough, came one Mr. Donald Trump in the White House early this year, and he's creating a huge turmoil because of his tariff imposition. And for what this world currently is facing, I describe it as VUCA condition: volatility, uncertainty, complexity, and ambiguity. And this has been the situation over the last 5 years. And as of now, on current reckoning, I think this situation is unlikely to go away anytime soon. Anyway, and therefore, the metals market and metals prices have remained volatile during this year, primarily because of the Trump-led trade tariff policies, which can only be described as erratic. Okay, I think it's absolutely knee-jerk, absolutely erratic, but we have to accept it. What can we do? The second key theme, the first theme is the tariff. The second key theme for this year, obviously, is the very subdued Chinese demand. All of us know China is the mover and shaker of the global metals market, be it industrial metals, base metals, precious metals. They are big players, and therefore, when Chinese demand gets weak or subdued, I think it has its own implication on the market and on prices. Another big theme that we are seeing very clearly emerge is the intensifying protectionism and what I also call resource nationalism. Countries want to protect their natural resources. Countries do not want to indiscriminately use, exploit, and export their raw material. And therefore, there is a certain amount of protectionism and there is a certain amount of nationalism relating to their natural resources. And this protectionism is actually disrupting established supply chains. And we all know what China did to the US in terms of the critical minerals, etc. Okay, we won't go into that, but we've covered all of this. Bina knows very clearly in the last 3 or 4 webinars, we have covered all of these aspects in Metal Trendzz. Anyway, but another theme I want to talk today very quickly, of course, is the AI adoption. Believe you me, when I interact with people within our country, even within Asia, I think the realization about the disruptive effect of AI is quite limited. I think AI adoption and technological innovation is across the world actually accelerating at a very rapid pace. It's supporting efficiency, supporting safety, it's supporting decarbonization. And the sooner we in India adopt and realize the importance of AI, I think that realization and adoption is extraordinarily important to keep our businesses, our trade, our industry quite competitive. Now, if we have to look at the outlook for industrial metals in the next quarter, this quarter, in my view, my analysis shows that the outlook is actually neutral to bearish. That's the kind of stance I'm able to see. This is primarily because of the anticipated downturn in metals demand for a variety of reasons. One is, of course, slower global economic growth. We know China is slowing down. We know Europe is slowing down. We know the US imminently will slow down. There's no doubt at all. The signals are already incipient, but over the next 2 quarters, there is a very strong likelihood of a slowdown. And therefore, when these major economies are slowing down, the overall global growth is under a challenge, primarily because of tariffs. Tariffs are pressuring growth, and countries are rushing to sign MOUs and agreements with the US, but there's another story. But global growth is set to slow down. China, which is again the mover and shaker of the market, as I said, had actually front-loaded all its exports in the last 2 quarters or so, and that effect of the front loading obviously will have to start waning, and therefore Chinese demand will continue to weaken further. And of course, we again talked about resource nationalism. Indonesia is a primary example of resource nationalism. Policies of that government, it wants to ensure oversight of the resource sector, very, very important. And Indonesia is a big producer and exporter for the metal sector is, of course, nickel. There is no doubt at all, which is a critical mineral. Otherwise, it's a big exporter of palm oil, big exporter of coal, big exporter of timber, etc., etc. But all these major export items are now under control. Export controls, the government wants domestic value addition and increasingly higher royalties. I think all this is also going to regulate export out of Indonesia, which is a critical market. And similarly, other countries are going to follow suit, including Philippines, etc. The next point I want to make, let us look at the LME base metals index. Notwithstanding all the challenges of tariffs, from the start of this year, it's up close to 10%, and driven primarily by copper, approximately up 14%, and of course, aluminium up 5%. Zinc and nickel, as we all know, the prices have just about stayed around or even slightly below the prices at the start of this year, start of 2025, primarily because of improved supply outlook. And the further upside potential, in my view, for metals at the moment, on current reckoning, as I would say, looks exhausted. What are those drivers that would come up to change the direction? We still don't know, but demand is weakening, but at the same time, supplies are high, but stagnating. I think it's a very, very tricky situation. High supply, but no growth, stagnating supply. Demand is weak. And this is the kind of picture that is actually emerging. And China obviously is curbing its overcapacity. In steel, we all know it has set new limits on metals production. The 10 non-ferrous metals, including copper and aluminium, the production increase is now limited to 1.5% this year and next year. Previous 2 years, the increase was 5%, and now it is limited to 1.5%. I think these are things that are influencing the global metals market. All of us know the international study groups are all meeting in Lisbon prior to the LME week, which is to follow, and therefore when I look very closely at the numbers, I can only say wait for a surprise from copper. The copper S&Ds are being reworked, and we can possibly get a big surprise as far as copper is concerned. Therefore, we are in VUCA condition. We are in the market conditions are volatile. We need to learn to manage the price risk that comes out of this VUCA condition. From an Indian perspective, I must say, and as someone who is an independent member of the SEBI CDAC, and I usually provide a lot of policy inputs and trigger a number of debates within SEBI. In the last 3 years, SEBI has taken a number of initiatives to deepen and widen the commodity derivatives market. New participants are allowed, mutual funds, for example, alternate investment funds, category 3, for example, they are allowed. New products have been introduced. Index trading is introduced, which was not available until 4 or 5 years ago. Options trading, which was banned in the mid-60s. And then, of course, it was opened up in about 3 years ago, if I remember correctly. Options trading, both options on futures and options in goods, both are allowed. Services, your portfolio management service is now allowed, which was not allowed earlier. Therefore, I think this, because we are discussing indexing today, and of course, I'm sure we have expert speakers to discuss indexing. I just want to mention that index is obviously a structured product. The aim of this index is to provide very reliable benchmark for specified commodity groups. It can be a basket of diverse commodities, or it can even be a basket of related commodities. It depends on what we choose. And if we are discussing, if anyone wants to discuss commodity index-based futures, or commodity index based on futures, what is important is that the underlying derivatives must have enough liquidity. Then only the commodity index based on futures will have a huge amount of credibility. And very quickly, this is probably my last but one slide. Therefore, when we create an index, what is important is commodity selection and weight. That should be based on the production value and traded value, which is called value weighted index. I think that's very important. And then continuity, near month contract on expiration will roll into the next month. And what is also important is real time price calculation and periodic rebalance. And I'm sure all this is going to be discussed by the speakers to follow. While we are on price risk, and this is my last slide, I want to talk about what is called an on-call contract. With due respect to everybody, I'm not sure if how many in this audience and in our metals trade are actually aware of this on-call contract. This on-call contract used to be very popular in the 60s. In 1966, forward trading was banned by the government of India. But before that, in the 50s and early 60s, for cotton, on-call contract was very, very popular. It's something like, it's very close to a non-transferable specific delivery forward contract. Again, I'm not sure if there is enough awareness about a spot contract, a forward contract. Within a forward contract, you have TSD and NTSD. Then you have a futures contract. Then you have options contract. There are different kinds of contract. And I think maybe, Binaji, there is an opportunity to do awareness training and education program on that. But okay. But the point is, in an on-call contract, which I would request the metal market stakeholders, metal sector stakeholders to explore, the price is fixed after the contract is signed. Okay. But there is if there is a premium for better quality, price premium for a premium quality, that price is pre-agreed. That premium is pre-agreed, and then the price is fixed subsequently, and the price is decided usually based on the price traded in a futures contract of a specific month, which is the buyer's call, probably closer to the date of delivery that has been agreed. It's a very, very interesting contract. This has worked. It used to work well probably 60 years ago. I think I would request the participants to examine the possibility of working on-call contracts. We at Metal Trendzz will of course be happy to conduct awareness, education, and training programs on all these aspects. It's very interesting because I am absolutely convinced this sector, the metal sector in India, is going to expand like nobody's business. We are going the China way. Our metal production, metal processing, metal consumption, metal export, metal import, everything, and more of import, less of export. Everything is going to expand phenomenally over the next 10, 15, 20, 25 years. This is a market to watch. And therefore, I think with this, let me conclude by saying there is a disclaimer which I issue. I'm not a trader. I don't hold any trading position anywhere. I'm a student of the market, and I'm coming from that perspective. And my coordinates are here. Thank you very much. Good luck and God bless you all. Binaji, over to you.
Thank you, Mr. Chandrasekhar, for connecting the global dots so clearly. The takeaway is that macro shifts are not distant. They directly shape pricing strategies for procurement teams in India. Let's now move from the big picture to a more technical view of how pricing benchmarks actually works. For this, it's my privilege to introduce a visionary leader who has redefined the way India looks at commodities and market intelligence. Mr. Dhruv Goyal, the founder and CEO of BigMint Technologies, leads India's largest market intelligence company in the commodity sector. With more than 2 decades of experience, his journey is truly inspiring, beginning with iron ore trading and evolving into transforming the commodity landscape with cutting edge, data driven insights. An alumnus of XLRI Jamshedpur, Dhruv is celebrated as a thought leader and has been a sought after voice at prestigious global steel conferences, including those organized by WSA, SECI, MRAI, and ISA. His trailblazing leadership has been recognized with several accolades, including the DX Digital Transformation Award, ET Future Ready Organization Awards, ET Now Leaders of Tomorrow, Entrepreneur of the Year, and the National Entrepreneurship Award as well. Beyond awards, his perspectives frequently shape narratives in leading platforms such as CNBC TV 18, The Times Group, Business Standard, The Times of India, Financial Express, and The Mint. Today, we are delighted to have him with us to share his deep expertise and visionary outlook on metal pricing trends and insights, which I am certain will add tremendous value to our deliberations. Please join me in welcoming Mr. Dhruv Goyal. Over to you, Mr. Dhruv.
Thank you, ma'am. Thank you for your kind words. And Chandrasekhar ji, thank you for your context setting. So I will take my presentation from your words when you mentioned that India will be growing very prominent market. All metal is commodities is one thing which we have will go China way. We'll see a lot of exports, production, consumption taking place in India. So, very rightly mentioned, when we started this company back in 2010, we remember a lot of these decisions, pricing decisions were being taken by the promoters. They did not have any accountability. So they were not accountable to anybody. So if it's a loss, it's their loss. If it's profit, it's their profit. As India is growing, as companies are becoming big, the professional management is getting, introduced. They are taking decision. And when professionals are introduced, they are accountable for the decision making, and it becomes more important for them to make sure that the whatever decisions being taken are data driven and they have rational behind these decisions. So with this, I'll very quickly brief you that how indexing works in price indexing works in India, and as a price reporting agency, what role do we play in the Indian context. So very quickly about price. So price is the amount of money what buyer pays to the seller in exchange of a good or service for a value which they derive from either from the goods or service. Yeah. So there are different ways people discover these prices. One is over the counter. Over the counter means there are buyers, sellers who can negotiate, who can discuss one to one and can come to a price mechanism, price understanding based on a customized terms and condition. It could be credit, it could be advance, it could be delivered. So they are different. It's a customized deal for different parties. Second way of discovering prices is through exchange, wherein commodities which are listed on the exchange. So the price discovery becomes more transparent, as in because if there are many people transacting on the exchange, the price discovery becomes more robust. Third is auctions. One way of discovering prices is people will put their material on auction platform or through tenders, and they will try to discover prices through this platform. So here so exchanges, we have LME, MCX. They will they'll be presenting their case. Auctions we have M Junction. We play a role where the transactions happen over the counter, and those commodities which are not listed on exchanges for some reason, it could be maybe because of their trade dynamics, maybe because of the unstandardization of the grade, maybe because of the delivery, maybe because of the regulations. So there we come into the play, and based on our analysis, based on our expertise, we discover these prices for people to benchmark against their contract settlement. So before I move on to how do we discover prices, I would like to show a use case that will, probably help users understand better uh, about the price
I am
discovery mechanism.
Tanveer, representing Minera Steel and Power Private Limited. We are an integrated steel manufacturer. We start right from iron ore mining, and we manufacture iron ore pellets, sponge iron or DRI, and convert that into steel billets. So that is where we are located in Bellary, and that's where our plant is. I started this in 2006. And when we started this, there was no information or there was no data that was available. If you take an example of pricing, it was what people used to say. It was all hearsay. Somebody says X, somebody says X plus, and somebody says X plus plus. There was no benchmarking of prices for it, whether raw material or the end product. There was a lot of confusion in the industry. We didn't know how to take that forward, and a lot of time that caused us to price our product much higher or much lower than what the actual market was. When we started using BigMint's services, BigMint has actually played a very crucial role in enhancing our understanding of the market and the customer demand. Their data-driven insights, which is backed by data, helps us understand trends and patterns and helps us do our pricing strategies better so that we are at the market potential rather than being too high or too low. And it has been there've been various different insights. It's not only about sponge iron or iron ore pellet or iron ore. We have information on the amount of iron ore vessels coming into India or iron ore vessels being exported out of India. So we are able to ascertain what's going to happen 2-3 months later based on these results. So it helps us make much more informed decisions about us buying our raw material, selling products. So all in all, I think we've been very happy, and it has helped us manage our business better and make. I am Tanveer.
So this is one of the use case, and we are finding many more use cases in the Indian context. As I mentioned, when we started, most of the companies were promoter driven. It is a promoter driven industry, but the decision making has passed on to professional. So as in the professionals come into play, come and take this responsibility of transacting, whether buying or selling. So there's a lot of accountability on their decision. So I think they need transparency, as Beena ma'am and Chandrasekhar ji mentioned, that transparency is the key, whether it could be through third-party price reporting agency, whether it is through exchange, whether it is through auction. So ultimately, people want transparency. So very quickly about the roles of PRA. So PRA, as I mentioned, they play a very important role in discovering commodities prices, especially those commodities which are not listed on exchange. They have dissymmetry of information, ambiguity of information. So as a PRA, we collect information from the market, we standardize and validate this information. We create benchmarks with our expertise, with our people who have deep knowledge about the commodities. That brings transparency and mitigates the risk of either selling at a low price or not selling at a right price. So we are, as a PRA, we are an independent agency. We do not have vested interest in any trading activity. So this makes us one of a critical player in the ecosystem. Yeah. This is process that we adopt. It may differ from PRAs to PRAs. So when we identify any assessments, any market or any commodity to be assessed, we very in detail we understand that market. What is the total size of the market? Who are the relevant participants? What is the total merchant size? What is the total captive size? Then we identify the pooling participants. Pooling participants, as in people who are involved in the purchase and sale, whether it could be buyer, seller, intermediaries. Then we start collecting data from these participants and make sure that we have participation from all the stakeholders, right from buyer, seller, and intermediaries. Once the data is collected, data is in a very, in a very different way. Some people will give us advance rate, somebody will give us credit rate, somebody will give us X plant, somebody will give us delivered to plant. So once the data is collected, we normalize these data sets. It is so that it is apple to apple comparison. Once the data is normalized, we give rational to these data. Rationalization is giving weightages to certain. For example, we have higher weightages for the transactions and slightly lower weightages for the non-transaction deals. Once the weightages are given, we compute a final price, and then it is disseminated to the participants through different channels. And in case if there's any feedback, we listen to those feedback, try to understand where is the problem, and if we have to improve the process, we have to improve the methodology, we have to improve the data collection participant. We very actively pursue it and then get it implemented to the entire process. If there's any regulation compliances, so there is an international organizations of securities commission, which is also known as ISCO. So they have defined principles for price reporting agencies. It was introduced in 2012 for the oil price reporting, but also extended to other commodities. And these principles are voluntary. There's no mandate. They will not give you any certificate if you follow these principles. But if somebody wants to be transparent, if somebody wants to be credible, they can follow these principles, and we are one of them who are following these principles. From an Indian context, there is no regulation, or PRAs doesn't directly come under the SEBI. But in case if these prices are linked to any exchange, the SEBI insists you to be ISCO audited to make sure that you are following best practices. And as I said, that this is a self or voluntary practice to make sure that you are following the best practices in the global market. About BigMint, our forte is price indexation. We also have data insights, consulting reports, tenders, events, other as a bouquet of services. Markets that we focus on: ferrous, non-ferrous, coal energy, scrap recycling, logistics, agriculture, something which we have recently started. So this is all from my side. Again, thanks a lot, Beena ma'am and Chandrasekhar ji, for giving us this opportunity to partner with you and host this conference. Thanks a lot.
Thank you, Mr. Goel, for that clarity. It's clear that indexes are not just numbers. They are practical tools that can bring efficiency and trust into commercial contracts. But metal pricing doesn't stop at our borders. Global benchmarks shape regional and local dynamics as well. And this is where the London Metal Exchange plays a central role. I'm delighted to introduce Mr. Joe View, Senior Vice President at the London Metal Exchange. Joe, originally from Sydney, specializes in helping clients understand and access the LME. In 2016, Joe took up a post at LME in Singapore, covering clients in APAC, Middle East, and India. Joe has over 25 years in the industry across sell-side, buy-side, exchanges, and vendor organizations. Today, he will be taking us through how LME sets global reference prices for non-ferrous metals and how Indian companies can combine these with domestic indexes to build fair competitive contracts. Over to you, Mr. Joe.
Thank you very much, Beena. Appreciate the kind introduction. Thank you very much to the BigMint team, Dhruv, everyone. Great job in organizing this fantastic opportunity for us to share a little bit about our market. My name's Joe. I'm based in Singapore, but I do travel to India quite a lot, as well as the Middle East. I guess today I'll just run through quickly a little bit of an overview of the LME, just to get everyone on the same page. And then happy to kind of go into specific details. I've already started getting specific questions in my chat inbox on this Zoom call, so I'm happy to continue to answer that. But Just for those who are not familiar with the LME, we are about 150 years old in the global metals markets. Our origins date back to a few hundred years before that. Why London? Why metals in London? There's no mines there. Essentially, London was the first industrial revolution center of the world. So hence, all the metal around the world kind of congregated in London. And hence, when it's dug out of the ground, it used to take about 3 months to ship that metal from Chile, so the copper from Chile, to get to London, or the tin from the Malaya Peninsula to get to London. Hence, that is the 3 months basis contract. We're quite well known for our aluminium, copper, zinc, lead, nickel, and tin contracts, but we do have a suite of steel contracts as well. Mr. Chandrashekar mentioned that China is a very active futures market around steel in particular. We are a very active steel market outside of China. So we're probably the most active steel market outside of China for futures. And then we also want to future-proof ourselves. So we have a suite of kind of electric vehicle, battery material type contracts as well. A little bit of how much trade goes through the LME in a year. About $18.5 trillion of notional value goes through the LME. So in a day, that's about 700,000 lots of traded. So we hold the majority share of all the metals that's traded around the world. So what is the role of the LME? Why is it relevant? I guess a lot of people on the call here want to understand they're from the physical market. So what do we do for the physical market? So we have warehouses around the world. We'll go through in a little bit more detail later that allows participants to, as a market of last resort, deliver into the LME in cases of excess production, but also withdraw out of the LME in case of low supply. So that's available today. The world's getting increasingly complex, so we help navigate sanctions and tariffs. One thing to note, the LME price, you see this copper price or aluminium price, is excluding taxes and tariffs. The recent Trump tariff announcements or not announcements brings a lot of volatility to other markets, but we're a stable price because we don't include tariff cost into that price that we publish. We have a list of good delivery brands that we approve. So there's a lot of brands coming from India, especially in the secondary lead space, as well as recently in copper as well. So yeah, we're happy to kind of approve metal producers, smelters to come on the LME. The main value for the brand listing is that you will then have as a producer, an insurance policy. You can always deliver into the LME and achieve an LME price if you meet the LME specifications and brands. We are growing into new contracts. So growth contracts like steel, we view it as still a growth contract despite having the liquidity outside of China. And transparency, we help you understand how that price discovery mechanism happens. With an eye on sustainability, we are looking at delivering a price discovery mechanism for discovering sustainable prices. If there's a green premium, we can help discover. And then we don't dictate what green is. We let the industry kind of figure that out themselves. For the financial participants, the other side of the coin, the physical participation brings macro relevance, right? As a speculator, you want to be able to interact with the physical market. Like if it's a copper price, I want to be able to interact with a real user of copper, not a speculative number. So for financial participants, we have enhancing liquidity programs. We have market data visibility, and also we've just delivered a huge multi-year tech stack for the financial community. So I guess the role of the LME is mutually reinforcing between both sides of the financial and the physical market. This is a little bit about the contract specifications, our 6 base metals, as I mentioned. I won't go through detail, but it's there. I'm sure these slides will be circulated after the Zoom call. And this is our steel contracts as well. So particularly the most liquid contract is the steel scrap in Turkey and the HRC China contract, FOB China. So that is it's the most of these contracts are incentivized. So we do have two-way pricing quoted throughout the day. So it gives you comfort to see the pricing throughout the trading day. A little bit of an overview on specifically the volume. So our most liquid contract is actually aluminium, trading about 225,000 lots a day, and then it's copper. The largest notional contract is copper. So 1 lot of copper, we're looking at $250,000 as well. That's quite chunky. I understand a lot of people think LME is a kind of bit of a wholesale market. So I'll be interested to hear your views on if we should be looking at smaller size contracts as well. In terms of volume on the steel contracts, around 3,000 to 4,000 lots a day. That's the steel contract for both. So there's 3 venues to interact with the LME. There is the open outcry where your category 1 members can participate in the open outcry in London. I highly recommend you, if you ever have a chance to visit London, drop me an email and maybe we can try to organize a visit for you to the open outcry. There is an electronic system, it's called LME Select, that does about half our volume. And then there is a phone brokered market as well, where our members help digest the liquidity for the clients. There's, in particular, the access routes LME. There is the what we call the high touch side on the right hand side, and then the low touch side on the left hand side. So both access routes is available depending how you want to interact with the LME, but is very specific in your use case. So I'm happy to have a chat to go through what each of these items mean. The warehouse delivery network is globally around the world. There is a kind of core for India to have a warehouse. I understand that we don't have a warehouse in India, but there is a lot interest. I get asked that every time I visit India. What needs to happen for a warehouse in India is the market needs to corral and get behind a mechanism for determining where the warehouse is based on the LME rules, and get the work with the government in India to work with us, because a lot of warehousing conversations need to center around what needs to happen, which is it needs to be at a place where it's net consumption of that particular commodity. It needs to have a deep port, and it needs to have easy access and facilities. So I believe India ticks some of those boxes, but the detail kind of needs to be ironed out, and it needs to come from kind of rule-based government level. To give you an idea, recent announcements around Saudi Arabia and Hong Kong took many years, and laws were changed to facilitate the warehousing in these countries. And then finally, the brand listing. So this kind of gives us the global map around where the brands are. So most of it is in Asia, including India. So yeah, so that's pretty much a quick run through of the LME, and happy to kind of field any questions.
Thank you, Mr. Joe, for your insightful presentation on non-ferrous markets, benchmarks, and exchange role. Your session has been clearly highlighted why the London Metal Exchange remains such an important reference point for Indian users, how it serves as a global benchmark for the non-ferrous industry, and different access models available for India. Your thoughts on the future direction of LME were especially valuable in helping us and understand where the market is headed. We truly appreciate the clarity and depth you brought to this discussion. To take us deeper into this dimension, we now invite Mr. Tamajit Payne, Editor and Deputy Head Market Intelligence Division, M Junction Services. Mr. Payne is a seasoned media and market intelligence professional with over 2 decades of expertise in metals, coal, and allied sectors. He services a joint venture of SAIL Steel. He leads the Ferrous Market Intelligence Division and edits 2 flagship publications, Steel Insights and India Steel Market Watch, a daily publication indeed. He also contributes to Coal Insights and India Coal Market Watch. With prior stints at Thomson Reuters, Business Standard, and UNI, Mr. Payne has developed strong expertise in pricing trends, trade flows, and policy developments, alongside curating industry conferences such as the Indian Steel Market Conference and Indian Coal Markets Conference. Mr. Payne continues to shape industry perspectives with his analytical insights and editorial leadership. Today, we are privileged to have him with us, and we look forward to his views on the role of e-auction platforms and price discovery and procurement, among other critical insights. Over to you, Mr. Payne. Thank you.
Thank you, Binaji, and thank you, Metal Trendzz and BigMint, for this opportunity. I am from M Junction, which is an equal joint venture of SAIL and Tata Steel, and we have come into existence from 2001. And we have been one of the first pioneers of digital commerce, and mostly in the commodity side. So I have a presentation and I'll try to cover it within the allotted time. So actually, I'll talk about a little bit of about the auction platforms, how it is important price discovering mechanism, and how it can be used by the procurement for strategic buys, and how the price risk can be managed through these auctions, and how the smarter contracts can be made. So as the distinguished speakers previously mentioned, that market is very volatile. So the volatility is the key word that has come out in all those presentations that have been given by the speakers before me. So market volatility is the new normal, and it is because of the supply chain disruptions, geopolitical tensions, inflation, tariffs, by the protectionism, everything. So auction platforms try to transform the sourcing and selling mechanism through a sequential negotiation process, makes it a competitive, transparent mechanism. So it is also a real-time market intelligence because it comes out with a lot of transactional data, and people try to discover prices by making competitive bids. So basically, it helps the procurement to drive down the negotiation process in a single day. And it's a long-term negotiation process can also be done through these auction platforms. It also helps the sellers to have a proper price discovery, and they can also bring down the time for the negotiations. So what actually the auction platform gives is a process of price discovery through competitive bidding. It also comes out with a lot of data. Internal benchmarking can be done by the procurement persons. The big picture about the entire global volatility comes into fore because the prices can be seen by all the bidders. And the market is means how the market shift is happening. We can discover that also through the various auctions. We can see how the volumes increase, how the volumes go down, what are the price changes like, and we can bring out the actionable insight from there. So as the previous speakers already mentioned that global commodity cycles, currency fluctuations, and policy changes are the main drivers of price change mechanism. So we track these shifts also, and whenever we organize an auction, we track the market shifts clearly. We justify what can be the purchase decisions, and they can also take the decisions internally. They can time the purchases during favorable pricing windows. And also we suggest our participants to benchmark supplier quotes against the market reality. This can also help the development of price. If they want to do a price escalation or de-escalation clause, they can have that also. So it's basically integrating the entire benchmark tracking through weekly routines. This is how the procurement functions look at, because they can use the dashboard tools that are there through the auctions. We generate reports after the auctions, before the auctions also, about the market. So they can go through those reports and take actionable insights. They can leverage the auction as an early indicator, because we give reports to the auction participants before the auction also, so that they can take informed decisions. They can have key KPIs built on the benchmarks that are achieved in the contracts. For example, if the prices is going down by 5%, or if there is a variation upwards by 5%, they can take that decision, what to do, whether to go for the buy or not. And so basically it helps the procurement and sales teams to monitor the situation through the auction outcomes. They can use hedging tools also if they want to. And volumes and auction methodologies help them to find out a transparent pricing mechanism. So basically, the procurement function looks at these auction methodologies through various ways. Means we firstly identify the core drivers, that is, what are the cost components that are driving the costs. Then we go for external index tracking also, in which we look at means how the benchmark indexes are behaving. Then there is an internal validation through cross-reference movements and the benchmark movements. Then we organize these options in which if the key index drops by 5%, they can stop the procurement for the time, or they can go for the procurement at an early stage. So this kind of decisions they can take. And this also helps in inventory optimization, because people are looking at how to clear the inventory levels in their organization, and to look at, means they are looking at how to address the volatility also through that. So basically, in conclusion, actually, I wanted to just highlight what are the platforms doing. The auction platforms are critical to pricing transparency and trend identification. The benchmarks provide a factual base for smart decisions. Procurement teams can optimize the timing, cost, negotiation power. They use index-linked contracts to manage the price risk confidently. So future procurement and sales is moving beyond negotiation. It is a mechanism design, basically. So they're looking at how to get a formula to come at a better price, a dynamic discovery, and how to structure the risk management. So this is what actually they're looking at. So thank you very much for this opportunity. These are actually my views, and thank you again for this opportunity. I'll be taking any questions that will come in the way. Thank you very much.
Thank you, Mr. Payne, for your brilliant insights on auction platforms, which clearly act as a mirror to domestic market demand and supply. On that note, let's move to the ground reality of how industry players in India are actually dealing with this volatility. We have with us Mr. Sanjay Mehta, President of the Material Recycling Association of India and Chairman of the MTC Group. Brings nearly 4 decades of leadership in the global metal recycling industry. Under his guidance, MTC has grown into India's largest ferrous scrap procurement, recycling, and steel manufacturing company with a global footprint. A passionate advocate of sustainability and circular economy, Mr. Mehta continues to champion world-class recycling practices for a greener future. He'll be sharing his expertise on managing volatility and negotiating deals. Over to you, Mr. Mehta.
Thank you very much, Binaji. At last, we are able to attend a Metal Trendzz
We are.
webinar. You were
I'm
following
so
with
happy
all of
about
us.
it. I'm so
No,
happy.
no, thank you so much. Thank you so much. I'm delighted to be here. My fellow speaker, Mr. Chandrasekhar ji, Dhruv Goyal, Jovu LME, Mr. Tamjit Pain from Metal Junction, they all are very, very well updated in their presentation, followed by their speech that how indexing is and commodity indexing of commodities definitely help in such a volatile market. But I'm really surprised on this webinar today that I'm the only one industry fellow speaker available on this screen among all these research people, big research people of BigMint and the MCX and the LME and the Metal Junction and everyone. I'm the only one person who's going to definitely handle everything. But I can say that in spite of all these mediums are available in this market, we keep reading a lot of news analysis, attending conferences, webinars, and trust me, it's not definitely easy to take decisions of future buying and selling in spite of so many indexing and price discovery recovery modules are available. Business has taken a different shape of ups and downs, new normal, which is definitely, as told by Meta Junction, that currency fluctuations, war, instability of political scenarios in any country, all this takes immediate effect on the commodity market. And same day, we get affected by the price movement in the market. It was not there before, but in last 1 year or say 2 years, every month the situation is getting changed. Definitely, it definitely helps us. I'm not saying that indexing and to say the whatever the MCX or BigMint and LME is definitely giving us good platform to use their indexing module and everything. It definitely helps. Non-ferrous metals definitely it helps us 70-80%, but ferrous market it is not helping us. Why? Because scrap is only available in the LME, and if I see LME of future LME of the HMS scrap for the February or say December, it's 373, 375. Example today, I can't see that market will move 375, 380 because the market is so downturn and demand is definitely lacking. There are a lot of issues in the market. So I will not say that it does not help, but definitely it depends on the luck factor, depends upon your team view, depends upon how you think about yourself, how the market will be. So for the trading industry, it is definitely it's going day by day. It is getting tougher and tougher for to take the decisions for any business, any industry, any trading company. It's not definitely easy. Of course, it saves us. Non-ferrous definitely it helps us. Currency also it's on currency also it helps us, but it's not 100% true. And we have to take our joint call between the team members, and then we take it forward. And I feel that everyone has given very good view of the market, and I'm happy to take more questions, whatever questions can come. I will not be able to add much more and on this, but definitely I'm happy to take many questions if any comes on this part, that how this industry and business is getting affected. I will definitely happy to answer. Thank you very much, Binaji.
Thank you, Ms. Mehta, for those valuable insights from recycler and traders' perspective, highlighting the on-ground realities of pricing, contracts, and dispute management. This gives us a clear view of how market participants navigate volatility in practice. To complement this, we now move to the exchange side. We are pleased to welcome Mr. Chitranjan Rege, head of the product management team, base metals and steel at MCX. He will share how hedging strategies can help safeguard business against such uncertainties and connect day-to-day challenges with the structured risk management tools. Over to you, Mr. Rege. Mr. Reddy?
Thank you, Binaji.
Thank
Thank you very much. Thanks, Dhruv. Thanks, everyone, for this opportunity. This is, it is always great to interact with the fraternity who is abreast with what's happening. To answer Sanjay Bhai's simple question, that if the uncertainty is growing by the day, that is where the entrepreneurship is all about, sir. I mean, we have seen how industry has dealt with it with lot of vigor, lot of confidence, lot of courage. Let me tell you, Sanjay Bhai, that the entire effort, the exchanges world over, I mean, I'm sure, Joe would also agree that their efforts in the direction of doing something right on ferrous is an attempt to ensure that there is some credible mechanism which comes into play, which will supplement the decision making in some way or the other. While we have not reached that far on MCX on the ferrous side, but I can tell you on the non-ferrous side, we have covered some distance. And but when we say so, I mean, the trade is, clearly divided into, say, international and domestic. And on the global front, the way REMI contracts are designed, and the details of which the Joe gave us in terms of having locations which are duty free, freely trading currency, and so it gives a very good perspective on how the globally the demand supply equilibrium. Because the fact of the matter is that the metals or any of these commodities are where the supply will naturally be concentrated in few geographies. So, I mean, if the Chile is going to produce 45% of world copper, I mean, there is little one we can do about it. But the other side is the consumption is more application driven, and it's far more uniform, or I would say evenly divided in terms of this thing. So, that is where the global price discovery comes into play. What I've tried to, probably supplement in today's decision making, or the idea is to share our views as to, in case when when we you want to position the contracts trade on MCX, how they are solving for this puzzle for the domestic industry. So I mean, simply put, we have the aluminum, copper, lead, nickel, zinc. These are the anyways the flagship contracts on the base metal front for us, and I'm sure these are the flagship contracts for LME as well. So this is simply put how this whole constitution is all about. The last three things are the most critical. I don't need to emphasize anymore that industrial applications are zooming, and criticality of that particular product is getting defined by that. Availability has a region specific angle, and the usage is worldwide, so that becomes a angular thing. And the biggest thing which is now coming into play is recycling. The limitation with which the resources are available, the dependence on recycling is growing by the day. And in fact, if we look at the EV story, which is unfolding in front of us now, the supply of the primary itself is limited, and having a mushroom, very micro level applications in variety of these things. I mean, once the product probably comes back into the circular economy, how it has to be extracted and refined and brought it back into the system. So, which is what we thought that I'm going to specifically give you or spend time in explaining that when we have listed the primary contract. So this is the design of us. Aluminum, we have two combinations, a 5-ton contract, a 1-ton contract, very similar to zinc and lead, where again bigger contract is 5 tons, smaller contract is 1 ton. Copper, we have 2.5 tons contract, and the nickel is 1.5 tons. This entirely being a delivery based model, what our contracts are is inclusive of everything possible without GST. So the screen price has got GST component outside of it. GST will be dealt at the time of delivery for the deliverable lots. But what you see on screen will have customs duty angle to it, will have currency angle to it, it will have premium discount to it, it will have delivery, the transport cost to it. And progressively, what we are now doing, otherwise we had a strong presence east, west, north, south. We are going to rationalize our warehousing to really serve the purpose for the industry, or say price discovery even better. So from November expiry onwards, our aluminum and zinc contract would have, our aluminum contract would have only the primary center is going to be Raipur, and the Thane and combination, Thane West and East combination, Calcutta combination will prevail. We are removing the Palwal, the North and South from the combination. Same is happening to zinc. So it will be a combination of Thane and Calcutta only. We are removing Palwal and Chennai from the equation. Copper from December onwards will be only Thane. I mean, in 5 years of our the delivery based model, we haven't seen any single ton of metal getting delivered at any other places. So, lot of these changes are also triggered from the fact that we want to simplify the price discovery and the whatever these minor complexities we have in GST dealing when we are dealing with multiple states, it will get simplified. So the idea is, the perspective to give you is this thing, and on an average we are doing pretty strong numbers in terms of volumes. I mean, nothing compared to what LME does, but on a local level, the on an average close to about 15,000 tons of metal getting transacted on aluminum, copper about 22,000 tons, lead about 4.5, zinc has got about 28,000 tons. All I can tell you is that the numbers used to be much different, probably 2-3 years back. With the rationalization of the warehouses, I'm sure the attachment of the price discovery or the trading fraternity or the hedging fraternity will bring back, and I'm sure the numbers will improve hereafter. Now, this is where I wanted to spend most of my time to explain. When I wanted to take advantage of the theme of the discussion, which is indexing. So what we've done is the entire physical market is glued into a fact that they would like to derive everything of the LME prices. So they would say, whatever is the LME price today, say crash settlement price of the aluminum, then you add something to it to bring it to India shores, then you do a customs duty element, then you probably do a currency angle to it, then you have to have. So there is a very set pattern in which the industry estimates what the price or the if the price on LME changes, then what is going to happen here. Now, these are the numbers which which we are trading on MCX, directly. So if aluminum right now is, say, suppose trading at 224, I mean, I don't know the number right now, but I mean 224. What we have done is that, keeping the premium angle outside of it, we have done the same calculation on LME. So we add some number or the other, and from the spot price, polled price, we remove the known components of LME. So LME CSP known, currency is known, duty factor is known. We have taken simple 1% percent as a factor for delivery and the overhead cost. That leaves us with a number which will be a premium or a discount on while trading on MCX over and above the LME. So this is how I think, this is what on ground I learned, that how people are trying to make assessment as to whether the demand is there, and if it is there, it is at what number. So what we have done is that we've taken a period of financial year 2024-25, Q1, Q2, Q3, Q4, and the 2 quarters which has just gone by in this financial year. So it gives you a perspective that in rupees per kg terms, each of these metals has got what number premium prevailing over the say LME's numbers. Purpose is to ascertain that one of the ways in which people index is that if they have to import metal, if they have to export metal, they have to negotiate the premium, and that premium actually can be one of the ways in which you can assess the premium is also to analyze the MCX prices and probably remove the known components of LME price and the rupee and the duty structure and all of that. It gives you a very hard and a very good perspective of how the prevailing prices or the previously premiums are for that region for our India price discovery. So so the numbers on the left hand side are for aluminium, and numbers on the right hand side are for the copper. And I would not I did not mention much about FTAs in aluminium, but I can tell you on the copper front, the free trade agreements what India has and the influx of metal coming from, say, Japan, the metal coming from, say, In zinc, a lot of metal coming from, probably Japan and South Korea. In various other metals also so that combination also comes into play. So it brings this additional, challenge that even if you have the known factors of, say, LME and currency and the this thing, but the premium gets impacted because there is additional flow of metal available from the free trade country. So our price discovery on screen is a subtotal of all of this, helping you to determine this thing. So it will index you to the starting point of LME over and above, and it will give a very good reference that if you have to import goods or if you have to export goods, where is the equivalent FOB or equivalent CIF price prevailing on MCX at this moment. These are the numbers on lead and zinc. As I told you, that zinc also sees a barrage of metal coming to India shores on the eastern side and on the western side as well, because of the galvanizing and the brass industries primary needs for this. And lead is a different animal altogether. I mean, the amount of recycling which this industry sees, on an average, we have about 12 to 13 lakh tons of metal being consumed in India. And after that, the primary lead coming from Hindustan zinc would be close to about 2 lakh 20,000 tons. And remaining everything, so close to about 80%, 75% of the trade is the recycled. So the batteries or the inverters which are coming back into the system and going back into the circular economy. Now, the numbers on that also are very, very different. So my point is that when we talk of indexing, and I would like to bring back the perspective which Dhruv gave, that what we have listed on exchange, whether for all the metal, the grade is standard, the purity is standard, the shape is standard, and that gives a very good starting point or benchmarking for the industry. Extending to the logic what Dhruv mentioned, that in case if you have to do an assessment of what should be the remelted lead price, what should be the battery scrap price, what should be the all of that combination can have or borrow their referencing from the MCX price, because if the end product which is being consumed for application is priced at, say, I don't know the number, but I mean suppose 180 rupees, and based on that you have to say that I am going to do a value add of 20%, and there is another overhead cost of, say, probably 2-3%. Removing 20 to 23% from the MCX price will give you a very good number that if you want to be profitable, that number buying anything higher than 78% or 77% of MCX price is going to be not profitable. So the utility of MCX price is manifold. It has created a benchmark in itself for the purity or the grades, which is all the BIS grade empaneled stuff already. Now, how to make how can industry make use of this is I would say multifold. People buying scrap, buying alloys, manufacturing alloys, or trying to do an intermediate product. All of that can actually reference everything to the MCX price discovery, because not only that it is giving you a hedge on the global prices, it is also giving you the local currency, it is also giving you the any FTA price, metal movement which is happening in and out of country, any premium changes which are going to reflect, and I'm sure it is reflecting in day-to-day this thing. When I say day to day, why I'm saying so is that the numbers what we have calculated are all quarterly numbers, just to give a perspective, because it gives you a on the history. But our prices are real time prices from morning 9 a.m. to evening 11:30. So whatever is happening to the world, whether it is demand supply, whether it is currency, whether it is supply constraint, whether it is geopolitical issues, whether it is Trump making statements, all of that is getting factored into our prices on a running basis, on minute to minute. So the price discovery and price decisions becomes far more easier, not only for the metal which has been listed or the grade which has been standardized and listed on MCX, but every other thing which is part of the ecosystem. So I will repeat myself, whether it is scrap, whether it is alloy, whether it is a blended scrap, meant for the places like, say, for brass or stuff. I'm sure it will be excellent. Not only that, I feel the lot of these auto component manufacturers can also benchmark their the pricing decisions to a reference has emerged over the period of time, having tried tested the delivery successively, should be done. Now this is to give you a perspective that when all of this is unfolding in the system, this is how it looks. We procure the spot prices by polling from the physical market, and this is how the prices are so closely correlated and they move. This is the zinc number. I mean, I had, with the paucity of time, I have limited myself to on this graph only for zinc and lead. But the premiums I have already covered all the four, so that it becomes easy for people to imagine what how this could be helpful. Now this is how the lead prices are, the spot prices, and over and above, the on top of that is the real time prices. And obviously, if you see there are bar charts which are there, is the quantum of delivery which happens on and off on MCX. Unlike LME, where practically the deliveries are everyday affair, on MCX the deliveries for any contract which are monthly contract is a month end affair. So last 3 working days of the contract or the contract month is when the deliveries happen. Otherwise, it's a price discovery between morning 9 a.m. to 11:30 p.m. Again, quantum of deliveries which has happened over the period of time, just to illustrate that in case the price swings are on one side, then there is enough metal in the system which comes in to bridge that gap or goes out, to make sure that the metal ecosystem price remains really married or galvanized around the MCX prices. So, and over the period of time, in last 5 years, ever since we converted the contracts to delivery settle, close to about 4,87,000 tons of metal has changed hands via the exchange delivery. And I am sure with the uh, exchange deliveries being positioned at delivery of last resort, we are playing our role, and I hope the price, PRAs, as Dhruv says, and and the entire industry which Sanjay Bhai represents, will be encouraged to use these prices for referencing their day-to-day purchases and sales and budgeting purposes, because all the numbers what we have showed today are for something which is history. But at any point in time, there are about 5 contracts which are listed on MCX, and first 2-3 contracts have decent liquidity. So it gives a forward view of the prices as to how the market expects this to unfold in coming times. So it's close to about 2 to 3 months of price view, which is also readily available. I just wanted to address one of the queries which was posted on the chat as well, as to what the projections are. So I would say that rather than going by the guesstimate by the analysts, it is far better to also refer to MCX prices, because it is giving you anyways a ready reference of real time how the price expectations are. I would not take much of time. I just wanted to make a point on how the indexing in the perspective I presented would be very handy for the industry to adopt and make use of. Thank you very much, Binaji.
Thank you, Mr. Chitranjan, for laying out the hedging perspective. This completes the picture from global policy to benchmarks to indexes, auctions, industry practices, and finally the futures. With the presentations concluded, it's time for what we have all been looking forward to, an interactive discussion with our distinguished panelists. So let me begin with my first question to Mr. Dhruv. Mr. Dhruv, I will be just posing the first question to metal price indices are often seen as sensitive and sometimes controversial, with buyers and sellers interpreting them differently. Inevitably, you must be receiving critical comments or challenges from the market participants. How do you manage such feedback? And in what way does BigMint ensures its price assessments stand out as rational, transparent, and reliable? Which is what the members would like to know.
Sure. That's for me, right, Bina?
Mr. Dhruv, or you can certainly, Mr. Joe, this also comes to you.
Mr. Dhruv.
We can have the same question for Mr. Dhruv as well. Yes, Mr. Joe.
I think Mr. Dhruv first, right?
Anyway, you're on the line. You can take it first.
Yeah, sure. I guess the question is, how do we make sure price is transparent and
Right.
work with criticisms if it's not transparent? My main comment when people say, "Oh, the price is too high," then you should sell it. It's a natural open market, right? If the price is too low, you should just buy it. That's my main comment, right? If the market determines what the price is as an exchange, I think Mr. Janaranjan would agree. We don't really get involved in forward price conversations with participants, but I would highly recommend that clients participate in the price if they think it is in any way different to what they think it should be.
Thank you, Mr. Joe. Mr. Dhruv, I would like you also to comment on the
Yeah.
same question.
Fine. So thank you, Bina ji. So you are very right. There could be, questions about the rationale. So we always say to our people that, discovering prices are, it's an art as well as science. To collect prices is an art, and to discover prices is a science. So we make sure that all our people who are collecting the prices, they are well equipped. They are well, they understand the commodities market in detail. We spend a lot of time in training these people so that they understand the nitty-gritty of the commodities market, how prices are being derived, whether whatever prices they are collecting from the participants, they also cross question so that when they give rationals, so they understand that whether the price submitted by the participants are qualified to be given weightage or not. So you're right, it's an evolving process, I would say, but we feel that when buyers and sellers, either both the parties are not happy or both the parties are happy, then we are doing the right job.
Good. But sometimes if you have a conflict, then how do you come to the resolving point?
So we understand the entire pain point of either the buyer or both the parties, understand whether we have gone wrong somewhere or whether their interpretation of the grades or the payment terms are wrong. And as I mentioned, that it's a continuous process, evolving process. We take that feedback very seriously and improve it in the process.
Good. So that means there is no rigidity onto it. What we say, we are the king. That
Absolutely
concept
not.
is not there.
Absolutely
That's
not.
very
So
nice.
also one thing that there is no perfect price in the market, is most market reflective price, because you cannot judge, because the price assessments that we are doing, it's the over the counter price. So every buyer, every deal could be different, every deal could be unique. So you have to make sure that you are very reflective to the market. It is not possible to give you the perfect price.
Thank you. I think Mr. Chandrasekhar wants to add in
Yes.
something. Yes, Mr. Chandrasekhar ji.
Very, very clearly, in the past, I have done all of this. There are scientific techniques available for price polling and bootstrapping of prices, etc. It's not easy, but over a period of time, it can be learned. We know which are the credible parties or parties from where we get credible information. There are also outliers who will give outlandish prices, but we know how to filter all of that. And therefore, I would actually say creating an index, having a long list of firms or companies from where you poll the prices, is a combination of art, science, and experience. Because experience teaches you who are the right people to go to. But you can't reach everybody in the marketplace. You got to sample. You got to have a small number, and then keep rotating that number from time to time. For it's art, science, and experience together that creates a good index. Is number one. Number two, as we all of us have spoken, trust, transparency, track record. I think this is what is important. If you have a good track record, people are willing to accept, and there is obviously it is because of trust and because of transparency. I think it will succeed. That's exactly what LME has.
Yes, exactly.
A very long track record. If my index is doubted by a large number of people, I will not survive.
Perfect.
That's the challenge, and therefore it is important. But scientific methods are available for coming to what should I say, an index with reasonable accuracy. We cannot be 100% accurate, but with reasonable accuracy. Yeah. So.
Yes, today's time we have come to the scientific reasons and with a complete rationale and a formulas.
Yeah.
With this,
Yeah.
I will come back to Mr.
Yeah.
Joe.
Yeah.
Mr. Joe, a question for you, Mr. Joe. How do exchange prices, regional premiums, and scrap values interact to influence overall market dynamics?
Yeah,
Mr. Joe?
I mean, yes, absolutely. So there are obviously regional premiums and discounts. I think our colleague Chittaranjan mentioned there is I can see -40 to +40, at least on the copper, USD per metric ton. I guess that's super important for local participants in India to understand. But I guess the baseline is for per ton of copper, we're talking about $10,000, which is quite a lot. So there needs to be a baseline in terms of where the pricing is, and then there needs to be a regional discovery. I must say, something I might share on the screen for participants is the way we think about kind of discovering price premiums. We think of it as a continuum along a spectrum as the market matures. I'm happy to share this link after the Zoom call. But if you think about the baseline as bilateral, more OTC type conversations, that's where kind of most price discovery starts off with, including regional premiums. And then you start looking at price reporting agencies like BigMint to produce journalistic type pricing. And then I think the way we think about this is physical trading platforms as well, right? As you get more mature down the market, there'll be a trading platform where people can put their offers in, and then bids come in, and then eventually there'll be a trade, right? And that's how we discover prices. But then the down the maturity path, we think as futures exchanges, we are the most transparent out there in terms of trying to discover premiums, discounts to regional pricing. So I hope this is helpful for participants today.
This is good.
And I'm happy to kind of share the link. I might pop it into the chat. I think our friend Chittaranjan wanted to add something to the last question as well.
In case our co-panelists would like to take this, any question on this subject further from Mr. Joe, if anybody would like to have any further information on this. Yes, Mr. Rege.
So, I fully relate and endorse what Joe is saying. The exchange perspective or exchange ambition is actually completely driven by creating standard, so that the entire ecosystem would get some price referencing. And which is why I want everybody to also pay attention to what Dhruv mentioned, that there is absolutely no reason that if the aluminium has got, like BIS, has itself recognized close to about 6 or 7 grades within the primary segment. All right. And there is one grade which the exchange would list. And then people are always wanting to know as to what are the other grades to be relatively priced at. If you do a smaller, minor value addition, in suppose, from the ingots and this thing, if it is going into the billets form or if it is going to the wire rod form, the industry would want to know that what. Now this assessment is where I think the Dhruv and the price, the agencies would be of great help. And I just wanted to tender one more thing incremental to what Dhruv mentioned. I think, and Dhruv can correct me if I'm wrong, that when I am dealing, suppose the underlying physical market is 1,000 tons, and if I am a dominant player, who's got about 300 tons exposure, the way in which the pricing decisions will happen for me are going to be someone who is taking the pricing decisions for, say, 25 tons. But the challenge with Dhruv is that he has to give you a single price, irrespective of whether you're dealing in 300 tons or whether you're dealing in 25 tons. Going back and telling him that you are wrong is one way to deal with it. Otherwise, the issue is that he has given you a very baseline activity or something to rely on, and that becomes a good reference for people to thereafter decide that whether you have to negotiate further to improve your chances, or you have to go by this. So my point is that as Chandrasekhar Saab mentioned, that the experience will say that how you use that benchmark. So my point is that the real-time price discovery, what the exchange happens, has its own role. There is a purpose with which the price agencies are going to give you a price referencing for variety. It could be for location, it could be for grade, it could be for form, it could be for a value add. And finally, it is the user of the price will have to take a call based on that, how and where he is going to make use of it. So I think there is a role for everybody to play. You have to be very clear as to where you would like to pick this for your benefit.
Thank you, Mr. Regan. Now, with all permissions, everyone permits, we will go extending our panel discussion for another 10 minutes. So bear with extension of time. I don't want to deprive the audience because we are running short for 15 minutes, I would say. So can we extend for 15 minutes?
Yeah,
I'm
okay.
sure nobody will object.
No problem.
Okay, the next question I put us to Mr. Tamajit Pay. Auction platforms are increasingly becoming a key mechanism for both price discovery and procurement. From your perspective, how are they reshaping buyer-seller dynamics in metal industry, and what gaps still remain compared to traditional pricing benchmarks? Mr. Pay, can we have this a quick answer from you?
Yeah. So actually, what my previous speakers, Joe, Chittaranjan, and Jyoti mentioned, it's really a combination of factors that drive price discovery. It is very difficult to come at a direct conclusion of a price discovery because, for example, in our platform, we deal with different grades. Sometimes we deal with defective steel also, which is having an error margin, means there is some defect. For that, we have to have some discounts. So it is very difficult to come out with the exact price discovery for all the products at the same grade. So we do what it's a combination of the thing. We take the benchmark pricing, then we do a little bit of discounting on the what kind of defects are there, and for that what prices the buyer would be able to give, what the seller is agreeing and accepting. So it's a combination of efforts, means we take a combination view and we come out with a pre-auction report to the clients, because it is very difficult to come at a exact solution to that. And just to mention, we are doing a lot of auctions, both forward and reverse auctions. Forward auctions for the sellers and reverse auctions for the procurement guys. We are doing a lot of auctions for non-core assets also. Like, for example, someone wants to sell a non-core asset like a helicopter. So this kind of, it is very difficult to come at an exact price for this kind of items or assets which are there in the market. So we take a combination of all the pricing benchmarks, then what error means, what is the depreciation like, what kind of discounts we need to give, what the seller is agreeing to, and what the buyer is agreeing to. So after the auction, the seller has the ultimate right to agree to the decision to whether to agree to the price or not, and then the auction concludes. So it's a combination that we are looking at always.
Thank you, Mr. Pin. That was very enlightening. And my next question I pose to Mr. Sanjay Mehta ji. Mr. Mehta, in your practical experience, how reliable have PRI benchmarks been in guiding buying and selling decisions? And where do you see the gaps between published prices and actual market trades? Mr. Mehta? Mr. Mehta?
Unmute.
Sorry. Yeah, Mr. Binaji, in my experience, we are facing, like Chittaranjan has already mentioned about the ferrous scrap, and they understood actually, BigMint and MCX and everyone. Our difficulty, non-ferrous side, honestly, I see the kind of MCX issued the contract in the lead, time to time in copper and everything, steel and everything. And on finished product side, they are really have done marvelous job, and discovery systems are available. On scrap side, it is getting difficult day by day, because example, LME has a only hedging contract, does not have a delivery contract. Okay, market does not behave in ferrous. I'm going to say just on the indexing or just on the hedging side. Market behaves in a practical experience of the grounds reality. What's happening? How's the demand is going on in the market? How's the auto sector? How's the construction sector is going on? How the everything around in India political situation? How the government is going to pump money in the future for everything, projects and everything. So it's definitely the day by day situation is getting difficult for the fairer side, and I really want that these people to help us out, especially M6 or BigMint or Metal Junction, that some kind of a strategy should develop to discover the prices of future in the scrap or anything in India physically available. I know it's not at all possible to deliver physical contract in ferrous worldwide. It is not possible. It is not going to possible for in India as well. But yes, it's difficult for us to take the real decisions. It's all depends upon the our IQ level, what we read, what we understand, what we feel in the market, and that's how the market is going behaving. And practical experience of the trade industry is definitely indexing, reading books, attending conferences. Everything is what is available in the market is medium. All the mediums is definitely helps us, but definitely, as I said before, also it's not the 100% solutions, and we need to and we need to take our joint decisions very well. After all, our luck factors also should support us, and that is definitely very much fact in the market, and it's market trend. You can't help it, and day by day, margins are shrinking for every trade industry, whether it's in foreign countries, whether it's in yard operations, whether it's manufacturer, whether it's Indian manufacturers or traders or everyone, they are facing very huge problems of the crisis of managing how to manage the funds, how to manage the business, how to manage the risk as well. So entirely the ecosystem is getting difficult day by day. It's not easy to run the business for any trade industry, and any master in the business, whether he will be master 10 years back, 20 years back, 30 years back. In today's environment, running the industry, running the business, it's definitely a challenging task for metal industry. It's not easy task. Thank you very much.
I do understand. I would like Mr. Dhruv to add on this to what Mr. Mehta has said. Can we try to take it further and see what solution we can help him out with what problems the industry is facing?
So I think Sanjay bhai very well mentioned that, especially in the ferrous side, there the indexing is the exchange. If you see, not many contracts are listed on the exchanges for several reasons. Because of the delivery, it is not possible to deliver the contract. Unlike, non-ferrous, when the quantities are smaller, you can still ship those cargoes. The standardization is far better. The non-ferrous markets are far standardized compared to ferrous markets. But we'll be very happy to work, with Sanjay bhai, understand the problem statement. How can we jointly work? The objective
Address the
is to
issue.
bring more transparency, efficiency in the market so that the margins for both the buyers and sellers are protected.
Thank you. I'm sure we can jointly, there's this platform, we get to know the problems and we can come to some solution. We can help out the traders and this thing. With this now, I can take a next question with Mr. Joe. Mr. Joe, in what ways can Indian companies integrate LME benchmarks with domestic index to design contracts that are both fair and competitive?
Sure. So I think you need to understand where the LME prices are. I mean, I think the first step Indian companies need to see and use in their physical contracts the LME pricing, so indexation, benchmarking, all these good things, and then they can then be able to do pretty interesting once it's in the physical contract. They can do things like if they have a floating price with their customer, they can create a fixed price, for example, using the derivative contracts on the LME as well. So I think that is a kind of a novelty that's quite important, and people need to understand. If you're a stockist, you're holding metal inventory in your warehouse, and you want to keep it for 3 months, and you don't want to be exposed to the price changes, you can put a hedge around it using a futures contract. So that's hugely important. So Indian companies have a multitude of ways to participate with the LME, but the first thing is please index the prices, use that in your physical contracts, and then you can participate in many ways with the LME. Happy to kind of go through your specific use case and details as well.
Thank you, Mr. Dhruv. With this, I'll come to another question to Mr. Dhruv, where we talk of the prices now when Mr. Sanjay Mehta has also mentioned, and even others from the chat box, as I see, they all have one concern about the published prices. So here, as we gather from your presentation, BigMint is dealing very methodically and rationally in arriving at what I would term as domestic landed prices. With this scientific approach, may I ask you how well BigMint's metal price index prices have been accepted India? I won't say globally right now. First, let's just talk of the India.
Binaji, what we have observed, as I mentioned in my presentation last 10 years back, most of the decisions were taken by the promoters. So they were, they're not accountable to anybody, right? So their decision is their decision. Since companies are growing and professional management is getting introduced, so they need more data-based or rational-based pricing. So over a period of time, we have seen that many companies have started asking for indexes which they can embed with the contract. So the utility or the application of prices that we discover is changing quite rapidly, significantly in last at least couple of years. What we have seen, especially the volatility and uncertainties. So people want to be more sure, and they, as I mentioned that. If a professional is taking a decision, so the professional has to be accountable for that decision. So they like to index it either with they want to index their purchases, be it with third party index, whether it is through auction platform, through exchanges, so that they can give a rationale to the management.
That's interesting. Bigway has paved its way in a big way into the markets. That's all I can say here. And with this, I will have one question for Mr. Chitranjan. Mr. Chitranjan, given the interplay between MCX prices, LME benchmarks, and domestic index, how should Indian market participants respond to these prices signals in their day-to-day decision making?
Yeah, so I think you partly answered this thing earlier.
But since
when you want to export anything to the overseas market from India, so I think the other side of the trade is going to ask you the quotes or this thing, basis the LME. So it becomes far more easier for you to decide as to what should be the prices linked to LME. Explaining becomes easier. Negotiations becomes easier. The referencing, because the forward dates, forward curve is available, becomes easier. That's one side of the story. On the domestic front, because we have listed our own standard grades linked to BIS, so the price referencing for that particular quality, that grade, for that shape and that for location becomes far more, I would say, transparent if it is linked to the MCX prices. And moment you are doing everything else in the ecosystem, whether it is a variety of grade, whether it is a variety of shape, whether it is a variety of value add, whether it is a variety of a different location, I'm sure the indexing would be of great help. So it is coming, I'm saying at the cost of repetition that what Chandrasekhar Saab said, that it's also a matter of experience, that the thing for which you are negotiating, you know your cards well, then you have to choose as to which combination will help you to get you a better price or a better outcome of the deal you are trying to make. But the variety is available. You have to pick and choose as to what works best in that particular point in time.
So alertness is something what we need to have in this. Thank you, Mr. Rege. With this one question I'll have for Mr. Tamajit Payne. So Tamajit Payne, now procurement teams today face high volatility and multiple for reference points. What practical steps would you suggest for them to effectively use the benchmarks monitoring, whether indexes, auction results, or global references when making day-to-day purchase decisions? Now here auction part is also there.
Yeah, so it's as I mentioned previously also, it has to be a combination. Means they have to have a dashboard in which means if it is a daily procurement object, they can have a dashboard over there. They need to procure. They know how much quantity they need to procure. So they are doing it either monthly or daily or whatever basis. So they know the prices are regular prices. So it is a different ball game. Means they have to use a dashboard. They have to have specific clauses in the contract, and means it is dependent on the prevailing prices that are there in the indexes, in the exchanges, and also the competitive bids that are happening. So it's a combination of the entire thing, because if it is a regular item, you will have to have a dashboard and some smart contract clauses which can help you, means, for example, if the price is going down, so you can go for a big buy. If it is going up, you can hold on the procurement for some time and wait for the prices to come down. So it has to be a constant monitoring, and means it has to be, it may be a weekly monitoring or a monthly monitoring, depending on how the commodity is procured. If it is a long-term procurement, and means you have to buy it on regular in some intervals, or while when you are buying it, you need that material on a single day or something like that. Means it's not an essential procurement. Then actually you will have to take.
Okay.
Yes.
Now, one question is there, which I would say is a very important question from the delegates, which in fact, I will start with this, and after that, I will open the platform for the delegates to interact. So this question I'm taking is from one of the members from IIF and the Foundry Fraternity, who have been very, very keen, not from today, from years I've been hearing. Now, they say when some of the public, now I would first refer this to Mr. Joe, and then I will take it one, because this I need to address to all of you. Mr. Joe, when some of the publications publishing metal index prices are not transparent enough to share price mechanism, how do we and where do we cope up such grievances?
Okay, that's a very interesting and thoughtful question, because I see people in the industry quite widely very keen to understand how price discovery works, and and how do they raise grievances. I think Mr. Dhruv earlier did mention IOSCO as the kind of like a global regulator of regulators. I think that's a good place, but then there's local regulators as well to speak through the transparency of prices and raise grievances. But I would kind of go down the commercial side and say, look, if it's naturally illiquid, you're not going to get a lot of price transparency, and if you go down the market maturity curve that I mentioned and showed and sent the link through, that's quite important to people to understand. Just some parts of the market are never going to be transparent and liquid, and is going to be very hard. And that's where the role of price reporting agencies like BigMint come and make a big kind of effort to bring more price transparency. But if it's a tradable price, whether discovered in a physical trading platform or on the an exchange, then I think there's no issues there. I think the transparent pricing is there, and we're heavily regulated industries, so I think that's quite a very important function to understand, that there's just natural parts of the market that are not transparent, and I just think there's you need to kind of participate on the prices if you want to understand and see a better market.
Okay. Thank you, Mr. Dhruv. Can I take your views on this, since you are already into this, I would say, taken forward this area?
Yeah.
You also must be experiencing such questions. I'll come back to you, Mr. Chandrasekhar.
Yeah,
Can
very
Mr.
quickly.
Dhruv answer on this?
So, ma'am, so this is again a very genuine question. So as I mentioned that, ISCO is one body which has laid down several principles and methodology. Having an open and transparent methodology is one of them. So, in case if somebody wants to practice or somebody wants to be transparent, the methodology is open for everybody. They can, go through it. They can challenge it. They can add value. But ultimately, as a PRA, our responsibility is that once the methodology is finalized, all the data collection processing will happen through that methodology until it is changed and communicated to the participants. So methodology, as you mentioned, it is open. It is available on the website, so people participants go and access. And in case if there's any feedback, as I said that no methodology is perfect. It's an evolving process. As a PRA, not only BigMint, I'm sure all the responsible PRA will be very happy to listen to participants' feedback and get it, implemented or amended.
Thank you. Mr. Chandrasekhar wanted to add something on the
Yeah,
subject.
I want to be very frank, and pardon me for saying this. I don't know who raised this question, but this question, I'm sorry, it is an illogical question. Number one, why am I saying this? Very clearly, this is a free country. India is a free country. People are ready to publish and willing to publish whatever number they are able to collect. Okay, whether it is an inspired number or whether it's genuinely captured from the market, we still don't know. But we can't prevent these things from happening. But what happens? The market filters all these people whose numbers are suspect. The market is far bigger than these individual price reporting agencies, and the market participants know clearly whose price they have to trust. So initially, a price reporting agency may succeed or appear to succeed, but it is not sustainable. It will not sustain. It will obviously start declining once people realize that their price reports are inspired. You know what I mean? And not realistic, not at the ground level. And then therefore, I think it is for the market participants to make an assessment of which reporting agency gives you more transparent, more credible, much better prices that relate directly to the ground realities than go. So it's all of us have to, we do it constantly. We try so many products in the marketplace, but some products we continue to use. Some products we discard. That's the process. I think it is simple. Because in India there is no regulation, there is nothing which you can do.
I think it's only the regulation which is expected so that the people business is not affected.
Yeah.
And end of the day, it is a business or consumer producers who have to take their call. I mean, with the experience with what is going in the practical prices and what is publishing. So it is the end of the day, the people have to take on the call. Mr. Payne, would you like to add on this something since you are also into the publishing business?
Yeah, actually, we are a auction platform where everything is transparent. Both the sellers, buyers know what the bids are. When the auctions happen, the bids are open and they can bid if they think the bid price is high. It is up to the bidder not to bid. Means it's up to the market. Means it's open to the market. And also, as my other panelists also said that you can come to a price discovery up to a certain extent, but there is a limit to how you can price market sentiment. I mean, it is very difficult because the total, maybe you are coming to an accuracy of up to 96, 97%, but there is a 2%, 3% part of market sentiment which is also involved. So how can you price that market sentiment? So I don't know, means we have to find out a solution, but the market is open, means it's up to the market to decide what's the exact price.
Yeah.
I want to, sorry. Let me put it, I think again, my understanding, I've been in this business for decades. What we are discussing is creating a good index, a credible index, transparently created. And that index will be based on traded prices. Is that right?
Okay.
Sentiment is going to drive the market tomorrow and day after. Sentiment has already driven today's market, and you have discovered today's prices from a very large number of people, and then you are indexing, creating an index out of today's prices. End of the day, EOD prices.
Okay.
Tomorrow the sentiment will change. Therefore, tomorrow the prices will change. Therefore, to say that this price of today will not be able to capture the sentiment of tomorrow, I mean, that's not acceptable. Tomorrow is tomorrow. We are discussing today's sentiment and today's prices and indexing today's prices. This is one second. The second one is there is something called mapping the market thought. Maybe we'll have on some other occasion, we'll have a discussion on how to map the market thought, which is exactly where the sentiment will come and which is exactly where price forecasting and price outlook would come, where you have the fundamental approach, you have the technical approach, etc. But that's
Okay,
a different
Chandrasekhar ji,
conversation.
let's come to the wrap up because we are really come to
Bina,
nearly
go ahead, go
half.
ahead. Sorry,
No,
I think, but I
See,
thought I
we
must
will not
clarify.
see.
Please,
There are a lot
please.
of questions from the delegates, but we will certainly take it on the emails, or we have plans because a lot of questions are related to commodity side. One logistic question which is there, certainly, if we can have a quick answer on that. Some people are asking for it because logistic additional cost to the LME prices is a very important subject which adds to the pricing. So here, I think Mr. Dhruv can add on it. When we are coming to our domestic landed prices and when we are adding logistic prices, how much do you find the difference in the pricing benchmarks can come?
So, ma'am, it depends on the assessment. For example, if the assessments are delivered to a site, we will add the logistics. If the assessments are on X factory or X workspaces, we will include the logistics. So it depends. Once we define an assessment, all the criteria, for example, payment, delivery, grade. So similar to what an exchange make, but we are exchange. So we also make a standardization of the contract. Of the assessments that we do, and accordingly we add or delete or we factor or we do not factor freights or other components.
Thank you, Mr. Dhruv. Now, as we have really crossed the time and many people who had come and have other assignments, so I won't be taking the questions much in detail, but we will certainly take up from the chat. And I would request my colleague Chaya to take the note of it, and we'll certainly email the questions and put up, otherwise put up on our YouTube and all whatever answers we have. With this, I would request Mr. Chandrasekhar ji to please wrap up with your views on what today's discussions, what we've had.
Okay. It's such a delight. I think we had a very fruitful, intellectually stimulating, and very informative discussion on a variety of topics relating to prices, indexing, risk management, etc. Dhruv talked about designing an index, the mechanics of designing it, talked about credibility and transparency. Joe from LME, of course, gave a wonderful background of what LME is, its track record. And one takeaway from what he said is there is no LME accredited warehouse in India. I think that's actually a big opportunity that's emerging. Tamajit Payne talked very well about auction platform. What are the benefits of auction platform? That it helps real-time price discovery, etc. Sanjay Mehta talked about the metal recycling industry representative. He talked about multiple market drivers, and he also, if I recall correctly, talked about scrap forward prices. If I can take half a minute more, Sanjay bhai, I'll tell you, I've been doing it for 20 years and more. There are 6 market drivers. You need to track 6 market drivers. Maybe we'll engage offline on that, and I'll share how to track those drivers, and that'll give you a reasonably good indication of where the prices are going. And then, of course, Chittaranjan always is very clear. He talks about the exchange perspective he brought, and he talked about utility of exchange prices, etc. We had a series of questions. All those are, I think, satisfactorily answered. But this conversation will go on for some more time. There is so much to talk, so much to communicate, so much to learn for all of us. But I think all good things have to come to an end at some stage. Therefore, I want to say a big thank you to all my co-panelists, particularly to, of course, our dear Bina Bain, who was so tactfully anchored this program, and of course to BigMint, Dhruv Goel and his team, Chaya, if I remember that name correctly, and of course all our co-panelists. Thank you very much. Good luck. God bless you all. We will stay in touch. This conversation must continue because this is an important topic. And hopefully there'll be another opportunity for all of us to meet together. God bless. Thank you very much.
Thank you.
On behalf of Metal Trendzz and BigMint, I sincerely thank our distinguished speakers and all of you for joining us. We look forward to your continued participation as we build knowledge and resilience in the metals ecosystem. Thank you all, and stay tuned up. We'll be coming up with the second in the series of this particular topic, because it has, as Chandrasekhar ji has mentioned, there's lots to talk, and what questions we have got, we will be taking the gist from this and developing the structure for our next webinar. So you won't be deprived of the answers. Thank you so much, and stay tuned with us. Thank you all.
Thank you.
Thank you.
Bye bye. Thank you.
Bye-bye. Thank you all.